Can dollar cost averaging really raise your rate of return? Is it really better than lump sum investing? And does it really lower your risk of buying when the market is at its peak? Does dollar cost averaging actually work? Hey everyone, Daniel here, and welcome to Next Level Life, a channel where you can learn all about investing, debt, retirement, and many other financial education videos besides, because let's face it, the schools aren't going to teach it for us. So if any of those topics sound interesting to you, or if you want to learn how to better handle your money and have more financial freedom, be sure to hit that subscribe button and the bell next to my name to be notified every time I upload a video. Well, buckle up my friends, because today we're diving into another heated debate in the investing world. In this video, I'm going to be telling you what dollar cost averaging is and explain how it works. I'm going to talk about its advantages as well as its disadvantages and why so many people recommend it. And of course, I'm going to answer the title question of the video, does it actually work? Let's get started. So what is dollar cost averaging? Well, dollar cost averaging is simply an investment technique where you purchase a fixed amount of a particular investment on a regular schedule, regardless of the price of that investment at the time. An example of this would be purchasing $100 a month worth of shares in Apple stock every single month, regardless of what Apple is valued at that month. So let's take a look at how this works. As usual, I'm going to be using the S&P 500 with prices from 1977 to the end of 2016 as my example in this video. So let's say John is capable of investing $100 a month or $1,200 a year into the market. For the sake of this example, let's say he just got a small inheritance of $6,000. If he were using dollar cost averaging, he would put a portion of that $6,000 into the market regularly. Let's assume that he spreads his inheritance investments out over the course of 3 years. So on January 1st of every year, he is going to put $2,000 of his inheritance into the market. He's going to do this in addition to his $100 a month investment. So he puts a total of $3,200 into the market in 1977, 1978, and 1979. In 1980, he goes back to his regular $1,200 a year investment. If he were to continue that all the way up until the end of 2016, and he were to match the S&P 500 during that time, he would end up with a net worth after 40 years of $524,430. Now you could ask, why is he putting it in just once a year? If the goal of dollar cost averaging is to make sure that you don't buy at the high point of the market all the time, couldn't he just invest every month? Well, yes, he could. And if John were to do that with his inheritance investments, he would be investing a little bit under $167 a month from his inheritance, in addition to the $100 a month that he already invests out of pocket. And if he were to do that over the same 3-year period, and then go back just like in the previous example to investing $100 a month for the rest of the 40 years, he would end up with a net worth of just under $504,000. But what if he were to invest the whole $6,000 inheritance on the very first day? Well, that means in 1977, he would have put $7,200 into the market. His $6,000 investment from his inheritance plus the $1,200 out of his own pocket. He would then go on to invest $100 a month for the rest of the 40 years, and he winds up with a net worth of $543,907. That's almost $20,000 more than if he had used dollar cost averaging. But how can that be? Dollar cost averaging is supposed to lessen your risk, right? Well, not really. And the reason for that is because the market, over the long term, has a tendency to trend upwards. For example, back in 1980, the S&P 500 was valued at just under $130 a share. Just before the market crash of 2008, it was valued at over $1,300 a share. But that's pocket change compared to where it was in 2017 at about $2,600 a share. So in general, if you do have a decent pile of cash, you're more often than not going to be better off in the long run if you invest it as a lump sum instead of using dollar cost averaging. But if that's the case, then why do so many people recommend dollar cost averaging? Heck, why do so many financial advisors recommend it? Well, there are a couple of reasons for that, but I think the main one is that they don't want to lose a client, at least in the financial advisor's case. Say, for example, if they had a new client put in a lump sum on October 9th, 2008, right before the crash. What do you think this new client would be thinking about their financial advisor once the market tanked? They probably would not be too happy. I certainly wouldn't be, and as a result, it would ruin the advisor's reputation because you'd better believe that word would get around to the client's friends about how bad of a financial advisor that person was. So I get where the advisor is coming from. However, despite the fact that dollar cost averaging, in most cases over the long run, doesn't work out, that doesn't mean that there aren't still advantages to it. And that doesn't mean that it's an option that nobody should take. I mean, if it's just too much risk for you to handle right off the bat, putting all your money right from the start into the market, then use dollar cost averaging. Because even if over the long haul it probably wouldn't work in most cases, if it comes down to a question of whether you're investing or not investing in the first place, I say that the choice that gets you to invest in the first place is always the right decision. Also, dollar cost averaging can work out over short periods of time. Say for example, John was getting ready to start investing in 2007 instead of 1977. He still has a $6,000 inheritance and was still able to invest $100 a month of his own money into the market. From 2007 to 2011, the market obviously went way down and then slowly back up. From about $1,380 in 2007 to about $1,312 in 2011. Now, if John had invested the full $6,000 as a lump sum in 2007 and then invested $100 a month all the way up to 2011, he would have a net worth of $12,652. But if you were to use dollar cost averaging and spread that $6,000 inheritance over the 5-year period equally, investing $1,200 a year into the market in addition to his usual out-of-pocket investments, he would end up with a net worth of $26,553. So over the short term, it can work out in your favor. However, you do want to keep an eye out for certain things, such as fees from your financial advisor if they charge them, especially if you're only putting in a small amount of money. Say every month if your advisor charges a fee, you may not be getting the full effect of your dollar cost averaging if you're only putting in $25 or $30 a month. It may end up doing as much harm as it does good. But obviously that's something that you'd want to look over yourself because it's not something I can really do in this more general video. So does dollar cost averaging work? From a purely analytical and mathematical perspective, most of the time it doesn't, at least over the long haul. Like we saw, there are certain cases where over the short term it can work out, particularly if you're looking at a period of time where the market wasn't doing as well. Also, as we established, it doesn't necessarily lower your risk of buying when the market is at its peak. Again, over the long haul, because the market generally trends upward. So what is the high point of the market today may very well not be the high point of the market in a few years. But it does lower, at the very least, the perceived level of risk for some, and makes it more emotionally easy to invest. And again, if the debate comes down to you either investing or not investing as the result of this difference, then I say investing in the first place is going to win every time. So those are my thoughts on dollar cost averaging, but as always, this is just the start of the conversation. I want to hear what you think. Leave your thoughts down in the comments section below, and that'll do it for me today. Once again, if you enjoyed this video, be sure to subscribe and hit the bell next to my name so that you'll be notified of all my future uploads. I generally upload every single Friday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.